Hi, welcome to Learn with Tree. This is the fourth video on leverages. In the previous video, we were looking at problem number 1, which was an introductory problem through which we learned all the concepts involved in this topic called as leverages. Now, in this video, I'm going to look at problem 2 and problem 3. I'm first going to be taking problem 2. Problem 2 has appeared in 4 RTPs, 4 revision test papers. It has appeared in the RTP November 2018. It has appeared in the RTP of November 2017. It has appeared in the RTP of November 2015 and also in the RTP of May 2015. So in all these 4 RTPs, you can find problem 2. A firm has sales of rupees 75 lakhs. The variable cost ratio is 56%. Fixed cost is rupees 6 lakhs. It has a debt of rupees 45 lakhs at 9% and equity of rupees 55 lakhs. There are 6 requirements in this question. 1. What is the firm's return on investment? 2. What is the firm's capital turnover ratio? 3. What are the operating, financial and combined leverages? 4. If the sales increases by 10%, what will happen to EBIT? 5. At what level of sales will the EBT of the firm be exactly 0? 6. If the EBIT increases by 20%, what will happen to EBT? So these are the 6 parts in problem 2. So let us take one by one. So the first one is going to be on ROI, return on investment. I'm first going to be defining ROI and calculating the value for this problem, and then I will be spending some time to explain what goes behind the calculation of ROI. But before I do that, an observation I want to make out of this problem 2, this question has 6 requirements, but there are 2 requirements out of the 6 which are not from this topic leverages, but which come from another topic called ratio analysis. So this is something that's quite common with questions in leverages. Not all parts of the question would be directly related to the concepts in leverages. You can expect a few of the requirements in the question to be from ratio analysis also. This is generally quite common with questions in leverages. So in this question, for instance, if you see, the first 2 are actually ratio analysis questions, and 3, 4, 5, 6 are directly related to leverages. So that's an observation I want to make before I start my discussion about problem 2. Okay, let's get to the first requirement, ROI. I'm first going to define ROI. ROI, return on investment, is equivalent to EBIT divided by capital employed. EBIT divided by capital employed. And when I say capital employed, I refer to long-term finance, invested in assets. Yes, this is what I mean by capital employed. So I'm going to be going ahead to first calculate the numerator, which is EBIT, and then I'll be calculating the denominator, which is capital employed, and then we can calculate the ROI. So the sales here in this question is 75 lakhs, and the variable cost in this question, they have told the question has told the variable cost is 56%. So I can take 75 lakhs and apply 56% on that. I get 42 lakhs. This is 56% of sales. So let me put that here, 56%. So the balance is what I call as contribution, and that's going to be 33 lakhs, from which I subtract my operating fixed cost. I subtract my operating fixed cost, and that is 6 lakhs. So I get 27 lakhs, and this 27 lakhs is called EBIT. So this is my earnings before interest and tax, and this is my numerator in my ROI. When I talk about capital employed, I said it is long-term finance, and in this question there are two sources of long-term finance. One is debt and another is equity. So debt plus equity gives me my capital employed, and again in the question debt is 45 lakhs and equity is 55 lakhs. So if I put them together, I get 100 lakhs, which is basically 1 crore. So this is my capital employed. So the ROI, which is EBIT by capital employed, I can say is 27 lakhs divided by 1 crore. I get 27%. Obviously, if I multiply this with 100, I get 27%. That addresses the first part of this question, which talks about return on investment. So I defined ROI and I've also calculated ROI, but I'm going to spend some time to explain what is ROI. ROI is a measure of the return that the company has earned for its long-term finance providers. So ROI is the return that the company has earned for its long-term finance providers. So if you look into this discussion here, we are talking about capital, and capital refers to long-term finance. So I have included both debt and equity here. So in this case, the company uses 1 crore of long-term finance. The company uses 1 crore of long-term finance. For the people who have provided this 1 crore of long-term finance, which would be debt providers and also equity providers, how much return has the company earned? How much return has the company earned is what is measured by ROI. What do I mean by the return that the company has earned for long-term finance providers? I am going to say that EBIT is the return that the company has earned for long-term finance providers. And why do I say EBIT is the return the company has earned for these long-term finance providers? It is because it is this number that is available for all finance providers. It is this number called EBIT which is available for all finance providers. Because only from EBIT I'm going to start subtracting all the financing expenses. So this number EBIT is available to all the finance providers. For instance, if I subtract interest from this and then I look at the next level called EBT, I can't call that to be available to all finance providers because EBT is not available to debt providers, since interest is something that has been already subtracted in the calculation of EBT. So if I need one number that talks about the profits available, the return available to all finance providers, that has to be EBIT. So that is why I consider EBIT to be the return available to all the long-term finance providers. So if I look at this ROI, it measures the return that the company has earned for the long-term finance providers and return divided by the finance used. The profits generated for long-term capital divided by the long-term capital used. So EBIT is the profit for the long-term capital, and capital employed itself is used as the denominator. This is just like saying I invest 100 rupees in some place and that gives me a profit, a return of 10, then I say 10% is my return. So how do I do that? What did I get for what I invested, right? Similarly here, the company has earned EBIT for the capital that it has taken. Or in other words, if all the finance providers together want to understand what is the return that the company has earned, they say 1 crore is what all of us together, when I say together, debt and equity, have invested, and for us the company has earned 27 lakhs. So that's a return of 27%. So this is how we understand this ratio called as return on investment. What's very important to understand is when we say the word investment, investment always refers to capital employed, and capital refers to all types of long-term finance, which includes debt and also includes equity. And if we had preference shares in the context here, we would have included that also, but since we don't have that, we don't talk about that. So that's all the discussion we need to have about ROI. The next requirement of this question is the calculation of what is called the capital turnover ratio. Capital turnover ratio. Again, like in the previous case, I am first going to define the ratio. I'm going to put numbers in place, calculate this for this problem, and then I'm just going to spend a few minutes time to explain what this ratio would mean. Right. So the definition of capital turnover ratio is sales divided by capital employed. Is sales divided by capital employed. So in this problem here, with the numbers that I have, sales is 75 lakhs and the capital employed we just calculated in the previous case was 1 crore. So if I multiply this with 100, I get 75%, but if I just express this in terms of number of times, I will say 0.75 times. Generally, ratios in the nature of turnover, I would say turnover ratios, these are also called as activity ratios. These ratios are expressed as number of times rather than as percentage. Return ratios are generally expressed as percentage. So ROI, we express that as a percentage, and capital turnover ratio, I'm going to express this in number of times, and that is 0.75 here. This is the definition and this is the calculation here. How do I understand the capital turnover ratio? What is the capital turnover ratio intended to do? The capital turnover ratio measures the relationship between the long-term capital employed in the business and the sales that is generated. What happens is there is capital, and here we are talking about, when I say capital, is always long-term finance. So long-term capital, this long-term capital is invested in assets. So when I say long-term capital, debt plus equity, so in our example it is 1 crore. So if the company has 1 crore of long-term capital, this 1 crore would be sitting in the form of some assets. So long-term capital gets invested in assets, and these assets generate sales. These assets generate sales. So indirectly, if you see, the long-term capital generates sales. So long-term capital is invested in assets. I would put this here, invest in assets, and that generates sales. So indirectly, the long-term capital generates sales. Measuring the relationship between this long-term capital and the sales here is what is done by the capital turnover ratio. For every unit of long-term capital, how much sales was the company able to generate? So for example, if the capital turnover ratio is 5 times, if the capital turnover ratio is 5 times, the meaning of this is for every 1 rupee of long-term capital employed, every 1 rupee of long-term capital employed in the business, 5 rupees of sales was generated. This is the meaning of a capital turnover ratio. So what we also will be able to infer is the higher the capital turnover ratio, the higher the efficiency of using the capital which has been employed. So there is capital, the capital has been employed, has been invested in assets. These assets are used to generate sales. But for every 1 unit of long-term capital in the form of assets, the higher the sales I'm able to generate, the higher will be the capital turnover ratio, and that also indicates higher efficiency of using the assets. So a rising capital turnover ratio would indicate increased efficiency of usage of these assets, and a dropping capital turnover ratio would indicate otherwise. So how efficiently is the company using its long-term assets, which is represented by long-term capital? If you need to understand that, then you'd probably look at the capital turnover ratio. So that's about the capital turnover ratio. So now we have addressed the first part and the second part of the question. The first was on ROI and the second was on capital turnover ratio. We understood the definition, we did the calculation, and we've also understood the meaning behind these ratios. Now let's go to the third part of the question, third requirement. This is a pretty straightforward requirement. The question is asking us to calculate the operating, financial, and the combined leverages. We know the formula that we can use. Leverages. We know operating leverage is equivalent to contribution divided by EBIT, and here the contribution was 33 lakhs. So if you go to the first part of the question, you would have calculated up to EBIT. So from that, contribution is 33 lakhs and the EBIT is 27 lakhs. So 33 over 27 would give us 1.22 times. So the operating leverage in this case is 1.22 times. Next comes financial leverage. Next comes financial leverage, and financial leverage is calculated as EBIT divided by EBT. So EBIT was 27 lakhs. Now EBT, we can calculate EBT here. Basically EBT is EBIT minus interest. So my interest here in this question is debt amount into interest rate, which is 45 lakhs into 9%, and this would work out to rupees 4,05,000. So my EBIT minus interest is basically 27 lakhs minus 4,05,000. So let's see what that is. 27 lakhs minus 4,05,000. That comes to 22 lakhs 95,000. 22 lakhs 95,000 and 27. This gives me 1.18 times. This is rounded off to 2 decimals, 1.18 times. This is financial leverage, and combined leverage is contribution divided by EBT. Alternatively, you can also calculate combined leverage as operating leverage into financial leverage. But let me do this here. 33 lakhs divided by 22 lakhs 95,000. So that is 1.44 times. This is the combined leverage. So this is the third requirement of the question. Let's go to the fourth requirement. If the sales increases by 10%, what will happen to EBIT? So if sales increases by 10%, what will happen to EBIT? Yes. Now we know from our previous discussion that the relationship between sales and EBIT is measured by operating leverage. For change in sales, how is the EBIT going to react is what we would understand by looking at the operating leverage. So in our calculation here, the operating leverage that we get is 1.22 times. So what would this 1.22 mean? By 1.22 of operating leverage, what we would understand is whatever happens to sales in the same direction, 1.22 times of that would happen to EBIT. Now, let me take you again back to the first problem that we discussed, problem number 1, where we had operating leverage at the base activity level to be 2 times. How did we understand that 2 times of operating leverage? We said whatever happens to sales or contribution, 2 times of that is going to happen to EBIT, and hence the operating leverage was 2 times. So if I understand operating leverage the same way here, I would say whatever happens to my sales, 1.22 times of that would happen in the same direction to my EBIT. So if my sales increases by 10%, then EBIT would increase in this, would change, basically would increase by 1.22 times of 10%, 1.22 times of 10%, which is basically 12.2%, which is basically 12.2%. So here we should understand that 1.22 itself is rounded off. But yeah, that's fine. Here, more than the accurate number, we are interested only in the main concept. So EBIT would increase by 12.2%. So whatever happens to sales, 1.22 times of that would happen to EBIT, and that's the meaning of 1.22 times of operating leverage. So we have answered the fourth requirement of the question, where we had to see what would be the impact on EBIT. Now let me go to the fifth requirement of the question. At what level of sales will the EBIT of the firm be exactly 0? So level of sales where EBIT will be 0. This is the fifth requirement of the question. EBIT is equivalent to EBIT minus interest. So if EBIT has to be 0, then EBIT must exactly be equivalent to interest. So that EBIT minus interest will give you 0 as EBIT. So in this question, we know that interest is equivalent to rupees 4,05,000. We know interest is 4,05,000 because this is 9% on 45 lakhs of debt value. So interest is 4,05,000. This means EBIT is also equivalent to rupees 4,05,000. 5,000. EBIT is also equal to rupees 4,05,000. So the reason being EBIT must be exactly equivalent to interest for us to get 0 EBT. So EBIT is also 4,05,000. Now, contribution minus operating fixed cost gives us EBIT. So this is what we saw in problem 1 in the format of the income statement. Contribution minus fixed cost, operating fixed cost gives us EBIT. So that would mean EBIT plus operating fixed cost would give us contribution. So contribution is equivalent to EBIT plus fixed cost. Obviously here it is operating fixed cost, and since EBIT is 4,05,000 and contribution is 6 lakhs, which is, sorry, fixed cost is 6 lakhs, we get the contribution to be 10 lakhs 5,000. This is the contribution. Now, the question tells us that 56% is the variable cost ratio. 56% is the variable cost ratio. The meaning is, if 100 rupees is the sales, 56 rupees is going to be the variable cost and 44 rupees is going to be the contribution. So if I say 56% is the variable cost ratio, then that means the contribution ratio is 44%. Contribution ratio is 44%. So sales into 44% would give us contribution. So let us say we don't know what the sales is. Let us say sales is equivalent to X. So X into 44% should give us 10,05,000. So we know the contribution is 10,05,000 and we also know that the contribution is 44% of sales. So I assume that sales is X. So X into 44% must give us 10,05,000. So that means X must be 10,05,000 divided by 44%, which would give me 10,05,000. It would give me 22 lakhs 84,000 odd. Let me round this up. 22 lakhs 84,000. So this would be my sales. So if the sales is 22 lakh 84,000, I can expect my EBT to be 0. How? A quick backward check. If the sales is 22 lakh 84,000, then 44% of that will be the contribution, which is 10 lakh 5,000. And if the contribution is 10 lakh 5,000 and fixed cost is 6 lakhs, then EBIT would be 4 lakh 5,000. If EBIT is 4 lakh 5,000 and interest is also 4 lakh 5,000, then EBIT minus interest is 0, which is 0 of EBT, which is what we wanted in part 5 of the question. So this is how we answer the 5th requirement of the question. And the last thing we need to do is the 6th requirement. And in the 6th requirement, the question asks us, what would happen to EBT if the EBIT increases by 20%? If the EBIT increases by 20%, what is going to happen to EBT? If the EBIT increases by 20%, then what would happen to EBT? This is the question. We know from the discussion that we have had earlier that the relationship between change in EBIT and change in EBT is measured by financial leverage. Is understood by financial leverage. The relationship between changes in EBIT and changes in EBT is captured through financial leverage. And we also know that in this case, our financial leverage is 1.18 times. So what is the meaning of 1.18 times of financial leverage? This would mean whatever happens to EBIT 1.18 times of that would happen to EBT in the same direction. So let me take you back again to problem 1, which was the introductory question where the financial leverage for the base activity level was 2 times. So how did we understand that? We said whatever happens to EBIT, 2 times of that would happen to EBT in the same direction. So if I apply the same logic here, then whatever happens to EBIT, 1.18 times of that would happen to EBT in the same direction. So here, if EBIT increases by 20%, then EBT would increase by 1.18 times of 20%. So which is basically 20 into 1.18. So that is 23.6%. So EBT would increase by 23.6%, which is 1.18 times of 20%. Yeah. So this is the sixth part of this is answering the sixth part of the sixth requirement in the question, the last part of the question, using financial leverage. So we have answered all the 6 requirements in problem 2, and as I said in the beginning, this question has appeared in 4 revision test papers of ICAI. Okay, now let's get to the next problem, which is problem 3. Problem 3 is a very simple problem. It just involves routine calculations. And if you look into what's required in problem 3, they just say calculate the operating, financial and the combined leverages. So it's just basically the leverage calculations using the formula that we have seen. Problem 3 has appeared in RTPs. So it has appeared in the RTP of May 2018. It has also appeared in the RTP of May 2017. And this problem is also there in the ICAI study material. Yeah. So you have particulars and amount. Installed capacity 4,000 units, actual production and sales 75% of the capacity, selling price 30 rupees per unit, variable cost 15 rupees per unit, fixed cost under situation 1 15,000, fixed cost under situation 2 20,000, capital structure in plan A, equity of 10,000 and 12% debt of 10,000, total 20,000, capital structure in plan B, equity of 15,000 and 12% debt of 5,000, total 20,000. We are just asked to calculate all the 3 leverages. Now, I'm going to have 4 situations here. I'm going to have 4 situations here. A1, A2, B1, and then B2. A1 would mean plan A, situation 1. A2 would mean plan A, situation 2. B1 would mean plan B, situation 1, and B2 would mean plan B, situation 2. Plan A or plan B, these plans are regarding the capital structure. In plan A, you have 50% equity and 50% debt, 10,000 and 10,000. In plan B, you have 75% debt and 25% equity, which is basically 75% equity and 25% debt, which is basically 15,000 and 5,000 of equity and debt respectively. So plan A and plan B is regarding the capital structure, and situation 1 and situation 2, they are regarding the fixed cost. So in situation 1, 15,000 is the fixed cost. In situation 2, 12,000 is the fixed cost. So once we capture this, then things are very straightforward. So I'm going to calculate sales, and in all the cases, sales are going to be equal. And what we should note here is though the installed capacity is 4,000 units, actual production and sales is only 75% of the capacity. So it's only going to be 3,000 units. So sales in all cases is only going to be 3,000 units. And every unit has a selling price of 30. So 3,000 into 30, that is going to be my sales, and that's going to be 90,000. So sales is going to be 90,000 in all the 4 cases. So Next, I'm going to subtract variable cost, and variable cost is 15 rupees per unit. So again, 3000 units into 15, that is going to be 45,000. And this variable cost also does not change in any of these four cases here. So it's going to be 45,000. So next is going to be contribution, which is the difference between sales and variable cost. That will be 45,000 again in all the four cases. From this, I subtract fixed cost. Fixed cost is going to change based on situation. In situation 1, here and here, it is going to be 15,000. So let me, in case 1 and case 3 here, both of which are situation 1, fall into situation 1, is going to be 15,000. If it's situation 2, which is this one and this one, it's going to be 20,000. So you have EBIT. So this is 30,000. This is 25,000. This is again 30,000. And this is 25,000. From this, I'm going to subtract interest. If I'm in plan A, I have 10,000 of debt and 12% interest, which is going to work out to 1,200. This is if I'm in plan A. If I'm in plan B, I have only 5,000 of debt at 12%. So the interest is going to be just half of this, which is 600 only. Right. So if I subtract interest from EBIT, I get EBT. And here 30,000 minus 1,200 is going to be 28,800. And sorry, this is going to be 23,800. 25,000 minus 1,200, 23,800. This is going to be 29,400, and this is going to be 24,400. So this is the EBT. Now, let me calculate the leverages right here. Operating leverage, financial leverage, and combined leverage. Operating leverage, I'm going to write the formulas here. Operating leverage is contribution divided by EBIT. So let me do that for all the four cases. 45,000 divided by, for the first case, it is 45 by 30. So it is 1.5. And even for the third case, even for B1, it's only going to be 1.5. For A2, it is 45 by 25. That is 1.8. And even for B2, it is going to be 1.8. So this is operating leverage based on this formula we have seen. Next is financial leverage, and that is going to be EBIT divided by EBT. So in A1, it's going to be 30,000 divided by 28,800. So that is, 30,000 divided by 28,800, 1.04. In A2, it is 25,000 divided by 23,800, which is 1.05. In B1, it is 30,000 divided by 29,400, which is 1.02. And in B2, it is 25,000 divided by 24,400, which is also 1.02. When I talk about combined leverage, it can be calculated as operating leverage into financial leverage, or I can simply calculate this as contribution divided by EBT. Contribution divided by EBT. So in A1, it is 45,000 divided by 28,800. So that gives me 1.56. In A2, it is 45,000 divided by 23,800. and that gives me 1.89. In B1, it is 45,000 divided by 29,400. That is 1.53. And in B2, it is 45,000 divided by 24,400. That is 1.84. So this is what the question wanted me to calculate: operating leverage, financial leverage, and combined leverage by just applying the formula that we have seen here. This is problem 3, and this has appeared in 2 RTPs, and you can also find this in the ICAI study material. Okay, so we have finished problem 2 and problem 3 in this video. So in the next video, let's look at the rest of the problem. So thank you for watching this video. Please subscribe to my channel on YouTube, Learn Mitri. I hope you enjoy the learning experience. Thank you again.